Warren Buffett, one of the three richest men on Earth, publicly admitted he pays a lower tax rate than his own secretary. Not because of accounting tricks, not because of corruption, but because of a completely legal system that most Americans have never been taught exists. ProPublica obtained actual IRS tax records of the 25 wealthiest Americans. Their true tax rate, meaning taxes paid divided by actual wealth gained, was just 3.4%. Meanwhile, the average American worker pays between 22 and 37%. How is this mathematically possible? That's exactly what this video explains. The secret isn't a loophole in the traditional sense. It's something far more fundamental. Billionaires and regular Americans have completely different types of income, and the entire tax system is structured around taxing the type of income that only regular people rely on. This video will make that completely clear. Here is the fundamental tax secret that wealthy families have known for generations. The U.S. tax code only taxes income when it is realized, meaning when you actually sell an asset and receive cash. If your stock portfolio grows by $10 billion this year and you don't sell, your tax bill is exactly $0. By the end of this video, you will understand 4 things: how billionaires generate wealth without creating taxable income, the buy, borrow, die strategy that eliminates taxes legally, how the stepped-up basis wipes out capital gains taxes permanently across generations, and which specific parts of this you can start using today. The most important concept in this entire video: wealthy people don't get paid, they accumulate. A CEO with $50 billion in company stock doesn't receive $50 billion in salary. The stock just sits there growing. No paycheck, no W-2, no taxable event. Their wealth increases by billions every year, and the tax code treats it as if it never happened. The tax code only triggers when you have a taxable event. Selling stock, taxable event. Receiving dividends, taxable event. Receiving a salary, taxable event. But your wealth growing by $1 billion because your stock went up, 0 taxable event. And if you die holding that stock, your heirs inherit it at the new higher value with the entire gain erased. This is the stepped-up basis. The stepped-up basis is one of the most powerful wealth transfer tools in the U.S. tax code. Here's how it works. You buy stock for $100,000. Over 30 years, it grows to $10 million. If you sell it, you owe capital gains tax on the $9.9 million profit. But if you die holding it and leave it to your children, the cost basis resets to $10 million. Your kids can sell it immediately and pay 0 taxes on the entire gain. The buy, borrow, die strategy is the cornerstone of how wealthy families legally pay almost 0 taxes across generations. Step 1. Buy appreciating assets and never sell them. Step 2. Borrow against those assets when you need cash to live. Loans are not income, and therefore not taxable. Step 3. Die holding the assets. Your heirs inherit with stepped-up basis, and the entire lifetime gain disappears forever. Why do billionaires borrow instead of sell? Simple math. If Elon Musk needs $500 million for personal expenses and he sells Tesla stock, he pays capital gains tax on the gain, potentially $100 million or more in taxes. But if he borrows $500 million from a bank using Tesla stock as collateral, he receives the exact same $500 million and pays 0 taxes because a loan is not income. Banks love lending to billionaires because the collateral is rock solid. A billionaire can borrow at 1 to 2% interest using their stock portfolio as security. Meanwhile, that same stock portfolio grows at 8 to 12% per year historically. They're earning 10% on assets they borrowed 1% against. The math is almost absurdly favorable. This isn't theoretical. In 2021 alone, Elon Musk had borrowed approximately $61 billion against his Tesla shares rather than selling them. Larry Ellison of Oracle keeps 98% of his net worth in Oracle stock and lives on borrowed funds. Mark Zuckerberg pays himself a symbolic $1 salary. The wealthiest humans on Earth have essentially no taxable income by design. Here's how the system works in daily life. A billionaire's portfolio generates no taxable income. It just grows. When they need money to live, they take a loan from a major bank at a low interest rate. The loan funds their entire lifestyle. The loan gets repaid eventually either from dividends, from a small strategic stock sale, or when they die and the estate settles. Zero ordinary income, zero payroll taxes, minimal capital gains. Strategy number 4. Charitable giving. Billionaires can donate appreciated stock directly to a private foundation, receive a tax deduction for the full current market value of the stock, and pay zero capital gains on the appreciation. The foundation is then controlled by the family, employs family members, and pursues the family's philanthropic agenda for generations. One move, multiple tax benefits. Here's where this gets genuinely exciting for your own financial life. While the buy, borrow, die strategy requires billions in assets to execute, the fundamental principles behind billionaire tax strategy, holding appreciating assets, using tax-advantaged accounts, and minimizing realized income, are completely available to you starting with your very next paycheck. Tax strategy number 1, the Roth IRA. This is the most accessible version of the billionaire tax playbook available to regular Americans. You invest after-tax dollars. Your money grows completely tax-free for decades, and when you withdraw in retirement, you pay zero taxes on everything, including all the growth. Zero taxes on potentially hundreds of thousands in gains. This is the people's version of the billionaire tax strategy. The math is staggering. If you max out your Roth IRA at $7,000 per year starting at age 25 and earn a historically average 8% return, you'll have approximately $1.9 million at age 65. Every single dollar of that $1.9 million comes out completely tax-free. That's potentially $400,000 or more in taxes you will never pay. This is legal. This is available right now, and most Americans don't use it. Tax strategy number 2, the Health Savings Account, or HSA. This is arguably the most powerful tax-advantaged account in the US tax code, and it's almost completely ignored. You get a tax deduction when you contribute. Your money grows tax-free, and you withdraw tax-free for medical expenses. After age 65, you can withdraw for anything, just like a traditional IRA. 3 separate tax advantages in one account. Tax strategy number 3, tax loss harvesting. When one of your investments is down, you sell it to realize the loss on paper. Use that loss to offset capital gains from other investments, and immediately buy a similar asset to maintain your market exposure. The IRS allows you to offset up to $3,000 of ordinary income per year with investment losses. Done correctly, you maintain identical investments but generate meaningful tax savings. Tax strategy number 4, understanding capital gains rates. If you sell a stock you've held for less than 1 year, your profit is taxed as ordinary income at rates up to 37%. Hold that same stock for just 1 day more than 12 months, and your tax rate drops to a maximum of 20%. And for most middle-income Americans, it's just 15%. One extra day of holding can save you tens of thousands of dollars. Tax strategy number 5. The 401k employer match is the single highest return on investment available to the average American worker. If your employer matches 50% of your contributions, up to 6% of your salary, that's an immediate 50% return before your money even gets invested. Plus, you get a tax deduction on every dollar contributed. Not maximizing this is leaving guaranteed money on the table. Advanced tax strategy, income composition. Wealthy investors deliberately structure their income to consist mostly of long-term capital gains and qualified dividends, which are taxed at 15 to 20% maximum, while minimizing ordinary income taxed at 37%. Every dollar shifted from the high-rate pile to the low-rate pile saves approximately 20 cents. At scale, this adds up to hundreds of thousands of dollars in lifetime tax savings. Here's a tax secret that almost nobody knows. If your taxable income is below approximately $47,000 as a single filer or $94,000 as a married couple, your long-term capital gains tax rate is exactly 0%. Zero. This means a strategic early retiree who keeps their income low can systematically sell appreciated investments every year and pay absolutely nothing in capital gains taxes. This is completely legal and completely underutilized. Real estate investors enjoy a completely separate suite of tax advantages. Depreciation allows you to deduct a portion of your property's value every year, even as the property increases in actual worth. The 1031 exchange allows you to sell one property and roll all proceeds into a new property without paying any capital gains. The primary residence exclusion allows you to exclude $250,000 in gains, $500,000 if married, when selling your home. For higher earners who exceed the Roth IRA income limits, $161,000 single, $240,000 married, there is a completely legal workaround called the backdoor Roth IRA. You contribute to a traditional IRA, which has no income limits, then immediately convert that traditional IRA to a Roth IRA. The result is identical to a direct Roth contribution. You get all the tax-free growth benefits regardless of your income. Here is your personal tax minimization pyramid. Start at the base. Maximize every single tax-advantaged account available to you. 401k, IRA, HSA. Layer 2. Hold all investments for at least 12 months to qualify for the lower capital gains rate. Layer 3. Harvest tax losses annually to offset gains. Layer 4. Structure your income to stay in lower brackets where possible. These 4 layers alone can save the average American tens of thousands in lifetime taxes. Here is what tax optimization means in real lifetime numbers. The average American earning $70,000 per year over a 40-year career who never optimizes their taxes pays approximately $600,000 in total federal and state taxes. The same person who uses available tax optimization strategies, Roth IRA, HSA, 401k matching, capital gains harvesting, pays approximately $350,000. The $250,000 difference invested at 8% is worth over $750,000 at retirement. One of the highest ROI investments a regular American can make is hiring a qualified CPA or tax professional. The average fee for a solid CPA is $300 to $500 per year. The average tax savings from a good CPA who actively optimizes your situation is $2,000 to $8,000 per year. That's a 4 times to 16 times return. Your CPA should pay for themselves many times over. If they don't, you need a better CPA. Quick note on the fairness question, because I want to be direct. This video is not political commentary. The wealthy do pay the largest share of total federal income tax in absolute dollar terms, but the Buffett rule observation is accurate. As a percentage of actual wealth accumulated, the ultra-wealthy often pay far less than middle-class workers. Understanding why this happens is not advocacy either way, it's financial literacy. Here is the most important thing I want you to take away from this video. Billionaires don't avoid taxes because they're corrupt or because the system is broken for them. They avoid taxes because they understand the rules of the game at a level most Americans never learn. Your job today is to start learning those same rules and applying every single legal advantage available to your situation. Your 5-step tax minimization action plan. Step 1. Open and maximize your Roth IRA. Step 2. If you have a high deductible health plan, open and fund an HSA. Step 3. Contribute at minimum enough to your 401k to capture the full employer match. Step 4. Hold all your investments for at least 12 months. Step 5. Hire a CPA who proactively optimizes your taxes, not just files them. This week's single action. Open a Roth IRA if you don't already have one. It takes 15 minutes on Fidelity, Vanguard, or Schwab. All three are completely free to open. Even if you can only put $50 in it this month, the habit and the account structure are what matter. The money follows the system. Build the system first. The cost of not knowing this information is staggering. 2 people earn the exact same salary for 40 years. One optimizes their taxes using available strategies. The other doesn't. At retirement, the optimizer has approximately $700,000 more, not because they earned more, not because they took more risk, but simply because they understood the rules better. Financial education is the highest yield investment available to anyone. The deepest insight from today's video: the U.S. tax system is fundamentally structured to reward owners of assets and penalize traders of time. The more of your income that comes from assets you own rather than hours you work, the lower your effective tax rate. This is why building an investment portfolio isn't just about growing wealth. It's about permanently changing your relationship with the tax code. I want to say something directly. This information is not secret. It's not hidden. It's available in tax code documents, in finance textbooks, in IRS publications. But it's never taught in school, it's not explained by most employers, and it's not discussed at the dinner table in most American homes. That's what this channel exists to change. You deserve to know this. 5 rapid-fire bonus strategies. 1. Max your HSA, triple tax advantage. 2. If you own a business, paying your children for legitimate work is legal and reduces your taxable income. 3. Investing in qualified opportunity zones defers and reduces capital gains. 4. If self-employed, a solo 401k allows contributions up to $66,000 per year. 5. If you own a business, the qualified business income deduction can reduce taxable income by 20%. Billionaires have their tax playbook. You have yours. They have buy, borrow, die, and stepped-up basis. You have the Roth IRA, the HSA, the 401k employer match, tax loss harvesting, and capital gains rate optimization. Their playbook requires billions in assets. Yours requires consistent habits, the right accounts, and the knowledge to use them, starting with whatever amount you have available today. Quick question for the community. Drop in the comments which tax strategy you're starting first: Roth IRA, HSA, maximizing your 401k match, tax loss harvesting, or all of them. I read every single comment and I'll personally reply to the most interesting responses. Your comment helps this video reach more people who need this information. Next week, the FIRE movement, financial independence, retire early. How regular Americans are retiring in their 30s and 40s, what the math actually looks like, and whether it's realistic for your situation. Spoiler: tax optimization is a central pillar of every successful FIRE story. Link is on screen right now. Final recap. 1. Billionaires generate wealth through appreciating assets, not taxable salary. 2. The buy, borrow, die strategy legally eliminates taxes across generations. 3. The stepped-up basis erases a lifetime of capital gains at death. 4. Your tools are the Roth IRA, HSA, 401k matching, and capital gains rate management. 5. The tax system rewards owners. Start owning assets today. Here is my final thought. The tax code was not written for the average American worker. It was written by people who understand assets, who own assets, and who benefit from asset ownership. Your best response is not anger, it's education. Learn the rules, use every legal advantage available to you, and start building the asset base that shifts your relationship with the tax code permanently. This channel exists because financial education should be available to everyone, not just people who grow up in wealthy families, not just people who can afford financial advisors, not just people who happen to take the right elective in college. Every video I make is one more piece of the puzzle that gives regular Americans the same financial knowledge that wealthy families pass down across generations. If this video changed how you think about the tax system, hit like and subscribe. I release one deep dive video every week breaking down exactly how money actually works, in plain English, with zero products to sell you, just the truth about how the system operates. Next week, we go deeper into how regular Americans are achieving financial independence and retiring early, some in their 30s, the exact math, the exact strategies, and whether it's realistic for your income level. You won't want to miss it. You don't need to be a billionaire to benefit from understanding the tax code. You need to open the right accounts, hold your investments wisely, and start today. Every strategy in this video is available to you right now, not someday, not when you're rich, today. Thank you for investing your time into understanding this today. Knowledge like this compounds just like money does. The earlier you learn it, the more valuable it becomes over your lifetime. 3 quick bonus facts. The US tax code is over 74,000 pages long. Nobody expects you to know all of it. Only about 2% of Americans max out their Roth IRA every year, despite it being one of the best tax tools available. And the average American leaves over $1,200 in tax deductions unclaimed every single year simply from not knowing what they qualify for. Here's one specific action. The next time you meet with a tax preparer or CPA, ask them this exact question. What am I not doing that could save me money? Most tax preparers only optimize what you bring them. Proactively asking this question shifts them into strategic advisor mode instead of just paperwork processing mode. One final thought before you go. Taxes are not your destiny. Your knowledge of the tax code is what determines your destiny. The same system that lets billionaires pay 3% has tools built in for you too. You just have to know where to look. And now you do. I'm Jax, and I'll see you next week for the FIRE Movement Deep Dive. Until then, go open that Roth IRA. Future you will thank present you for 50 years. Bonus fact, to close things out, you spent about 20 minutes watching this video. The strategies inside it can realistically save the average American over $250,000 across their lifetime. That might be the highest return on 20 minutes you'll get all year. 5 more rapid billionaire tax facts. The top 400 richest Americans often pay a lower effective rate than nurses and teachers. Jeff Bezos received a $4,000 child tax credit the same year his wealth grew by billions. Private jets can be fully tax-deductible business expenses. Trusts can shield wealth from estate tax for generations. And Puerto Rico offers 0% capital gains tax for qualifying residents who relocate. One advanced structure worth knowing about: the grantor retained annuity trust, or GRAT. Wealthy families place appreciating assets into this trust. The original value returns to them over a set period, but any growth beyond a government-set interest rate passes to heirs completely free of gift and estate tax. This is how families transfer hundreds of millions across generations while minimizing transfer taxes. You don't need a GRAT to build generational wealth. A 529 plan grows tax-free for your child's education. A properly structured will or simple trust can protect even a modest inheritance from unnecessary taxes and probate costs. Life insurance proceeds typically pass to beneficiaries completely tax-free. The principles scale down, you just apply them at your level. The deepest lesson from today isn't really about billionaires at all. It's this: tax knowledge is itself a form of wealth. It compounds. It applies at every income level. And unlike money, once you learn it, nobody can ever take it away from you. The most common question I expect from this video: isn't this unfair to the middle class? Here's my honest answer. Whether you think the system is fair or unfair is a political question I'm not here to answer. What I am here to do is show you the actual rules, so that whatever your position on fairness, you can legally use every tool available to you too. The real wealth transfer worth caring about isn't billions moving between generations of the ultra-rich. It's financial knowledge moving from people who have it to people who don't. That's the actual mission of every video on this channel. Closing that gap, one strategy at a time. Today's entire video in 3 sentences. 1. Billionaires pay low taxes because wealth from assets isn't taxed until sold. 2. The Roth IRA, HSA, and 401k matching are your version of their playbook. 3. Start using these tools today, because knowledge only pays off once it's applied. I'm Jax, and I'll see you next week for the FIRE movement video. Until then, remember, every dollar of tax you legally avoid is a dollar that keeps compounding for your future. Go put your knowledge to work.